Welcome to the Retirement Roadmap by SHP Financial, a podcast empowering today's retirees and pre-retirees to make well-informed financial decisions that will help you spend more time living and dreaming than worrying and wondering. Join me, Matthew Peck, along with my co-hosts, Derek Gregoire and Keith Ellis, as we share actionable financial strategies and insights, as well as interview top thought leaders in the world of finance, accounting, and estate planning. This is all aimed at preparing you for the retirement you've always dreamed of. Our high-quality holistic planning process has helped thousands of families retire and create what we like to call the ripple effect. The Retirement Roadmap is your guide to financial freedom. Are you ready to get started? Let's go. Welcome, everyone, to another edition of SHP Financial's Retirement Roadmap podcast. I'm your host today, Matthew Peck. There are over $10 trillion invested in 401ks, according to the ICI as of 2025. But yet there are common misunderstandings and common mistakes that people make, or just people don't really understand exactly how they work and what all the different levers are, like what's the contribution limits, and what are 401k loans, and what type of investment options are there. And it's such an important issue because the fact that the 401ks replaced private pensions. So this is now your pension. This is now your retirement. For a majority of Americans, the 401k is their retirement, but yet there's so many questions that are there, and I think so many missed opportunities. So to help us navigate this world of 401ks, I brought a specialist, a guy named Raphael Hanna, who he eats 401ks for breakfast, basically.
That's right. Yeah.
Is that
Cheerios and 401ks.
That's it's like. So I couldn't think of a better guy. But Rap's obviously been in the industry for a number of years, been working here at SHP, and obviously he and I work together on a team. So that's another reason why I wanted to bring him on.
Repeat guest, too.
Yeah.
Repeat offender, I guess.
Yeah. But very true. So obviously psyched to have you back on the show, to say the least.
Appreciate you having me.
And I love the idea of talking about 401ks because of, again, how important they are. So when people come to you at a cocktail party or whatever that is, what's the first thing you explain? So people, where do you go when it comes to understanding 401ks and avoiding mistakes?
I should preface by saying every cocktail party I go to, they talk about 401ks.
Oh yeah, because you're pretty cool. Like you're pretty hip.
It's a hot-button topic at cocktail parties. But I would tell you, when we think about 401k plans, I think you hit it on like the nail on the head to start. It's replaced pensions over the last 20, 30 years. So when you think about vesting and contributions and the taxation of the different buckets within your 401k, it's important to know, one, what's coming in, and if it's going out, how is it being taxed and where the dollars are going. So to answer your question, the first thing that we really think about is, I'll briefly touch on vesting, right? Okay. So when you go to an employer and they give you a 401k plan, they can potentially offer you what's called a 401k match, right? So let's say you're contributing up to the annual limit this year, where if you're under, between, up to age 50, you can contribute $24,500. So on that amount that you're contributing, your employer can come and tell you, okay, we're going to match, for example, 3% of whatever you contribute. But what people don't necessarily realize is there's something called a vesting schedule. Now, the vesting schedule is predicated on, one, you contributing, and then from there, when they do match it, the vesting piece of it basically implies when you technically own those dollars at that point. Okay. So if it's $24,500 and that's the contribution limit up till age 50, you need to understand that the 401k match piece of it could be vested to you immediately. It could be vested to you over 1 to 5 years. So depending on when you leave an employer, you might be leaving dollars on the table.
Okay. So the vesting schedule is specifically in regards to the match. It's not what the employee puts in.
That's
correct. This is just about what the employer puts in.
Correct. It's strictly about what the employer puts in, and they can only do it if you're contributing to it.
Okay.
Right? And again, the matching piece of it, Like I have one client that works at Google. His 401k match is up to 10% of what he puts in, right? So that's another piece. It's understanding what your match limit is, right? If I contribute 3, will they match 3? If I contribute 10, do they match up to 10?
Now, when you say 3 or 10, what do you mean?
So in terms of your contribution, if I contribute 3%
of your
gross
salary, or
gross earnings, correct.
That's what I was trying to figure out. So it's like, so if I'm going in and I'm enrolling in a 401k, or it's like a new job or whatever that is, or whatever your annual, how often you can adjust that. When I'm doing, when you talk about 3%, 5%, 8%, 10%, I think you mentioned as an example, that's how much of your weekly paycheck or your biweekly paycheck gets put in.
Correct. Okay. They take that number, and depending on when they run payroll, so if you elect a 10% contribution into your 401k over a 12-month period, they're going to take that by the pay period.
Okay.
Right.
But then there are limits, though. So it's like, what happens if you mentioned about the gentleman with the 10%. So because if the limit is $24,500 for folks under 59.5, if they're doing 10% of their salary, what happens if they're earning $500,000? 10% is $50,000. So what? It just comes off of one paycheck, or how do they manage that?
It's a good question. So the limits, like I said, up until age 50, the annual limit's $24,500.
Okay.
So clients that again are making north of 300, 400, 500,000. Well, we start talking to them about tax diversification. So if you're making contributions to your 401k and you hit that limit, well then where are you putting other dollars, right? Brokerage accounts, right? To get that after-tax diversification away from whether you're doing pre-tax 401ks or Roth, which we'll get to in a minute.
Right.
But again, like I said, up till 50, that's the contribution limit. And then between 50 and 60, you can make an additional $8,000 contribution above the $24,500 limit.
Okay.
So your contribution limit becomes about $32,500. And then from that point forward, between ages 60 and 63 for 2026, you can make an additional about $2,300 above and beyond that in terms of contributions.
Okay. Well, and I think, I'm just trying to sort of walk through and understand when someone makes their annual elections, right? Like, how do they? And then I want to come back to the match and the vesting and whatnot. But it's like, if a client is under 59.5 and their limit is 24,500, do they sort of then take that amount and then go over their salary, annually and say, okay, well, 4% of my salary is that, equal annually? I'm just trying to figure out how do they get to that limit, or how do they figure out how much they should kick in to? Should they match 3? Should they match 5? Or not match? I'm sorry. Should they contribute 3? Should they contribute 5? Like, how do you advise people on how much to contribute into their 401ks to begin with?
So initially, we kind of back into it from a cash flow standpoint.
Okay.
Right. So if, let's say, a client's making $150,000, you want to first understand what are their other expenses relative to what they should be saving. Right. So, let's say as we kind of back into that number, we find out that 5 to 8% of their savings should go to their 401k. Well, again, we're backing into that number based off of what their other expenses are, what their mortgage is. Are they paying for college, right? You try to figure out what their fixed and variable expenses are. And then from there, again, we try to project out how much they should be saving based off of what their income is. Okay. So generally speaking, that's how we look at it. And then at that point we say, okay, on a pay period basis, this is how much you would be electing. So again, on your 401k plans, it's very simple to add those contributions to say, okay, I'm going to contribute 5% this year based off of what I earn.
Okay. So, and they can figure out that 5% on, okay, here's my annual salary. Here's how much my variable costs are. Yep. And this is how much I can actually set aside into the 401k.
Correct. You kind of back into it.
You can, okay. Yeah, you're going to get that number. All right. So now I'm either hopefully hitting the limit with my 5%, or I am at least as close as possible. Again, budget allowing, like you were talking about.
Correct.
Okay. Now I'm contributing 5%. What does the company do? Right, and what's whole match world, and then how does vesting? Just let's go back to the vesting part of it. So as I said, I'm putting 5% in. Now I know there's a company's matching something, and now I know there's a vesting schedule.
Correct.
So remind me what those are again.
So the matching piece, right? So in the example that you used, if somebody's deciding after they back into their own budget that they should be contributing 5% of their gross salary into their 401k, well, then the matching piece comes in. And depending on the employer, your employer might say, okay, Raph, you're contributing 5% of your salary. Okay. Us as the employer, we're going to match up to 4% of whatever you contributed into the 401k.
So if 5% is 20,000, then they're contributing 4% of the salary, or they're doing 4% of that 20,000?
They're doing 4% of that 20,000.
Okay. So then that matches, let's say, oh gosh, it's too early for math, even though we're in finance.
Right.
This is terrible. But it's a Monday morning.
It is.
And I would
it
say,
is. And Pats did lose the Super Bowl.
Yeah, exactly. So we're a little bitter here.
A little wonky.
Okay. So that 4% of that 20,000 is what the company is giving free money. So they're putting in free money right now.
Correct.
Right? I mean, that the company is just putting on top of that 20,000 that you put in.
Correct.
However, there's strings attached with that vesting.
Correct. So, like I said, some employers, depending on how generous they are, they might have that vesting schedule vest immediately to you on day one.
Okay.
So you could potentially be fully vested on day one. On the flip side of the coin, you could be fully vested a couple of years down the road. So let's say in a random example, your vesting schedule doesn't happen for 3 years, right? You're not 100% fully vested on your match for 3 years. But you leave your employer 2.5 years in, right? Or 2 years and 11 months in. You potentially, depending on that timeline, you could be leaving a couple thousand up to thousands of dollars on the table.
Okay, interesting. So it's like, all of that yes, it is free money. However, you need to stay with that firm for a certain amount of time,
Correct.
or they take it all back,
and
depending.
Correct. And that information is readily available to you through your HR department. So they should be able to get you that information like pretty quickly.
Okay.
So
the first thing we're understanding is how much we can save, from our salary into the 401k. Then we're figuring out, all right, what's the matching? What's the free money that I'm getting from the employer? And how long do I need to stay at this company in order to get all that free money?
Correct.
Okay. All right. So now we have the contributions. We have that amount. We understand sort of the terms on the free money.
Yep.
Now, what about there's like Roth 401ks and traditional 401ks, and I guess the taxation. So now, how do we figure out what? I guess what's the difference there?
Yeah, it's a good question. So pre-tax 401k contributions, again, you're making those contributions with basically gross, they're pre-tax dollars. So it gets deducted if you look at your payroll before the taxes get taken out. So if you're contributing $20,000 into your pre-tax 401k, when you look at your pay stub, you're going to see that $20,000, however it gets taken out throughout the year, gets taken out before the taxes get deducted, right? Meaning what? Those taxes are eventually going to become due at some point. Obviously, not at the point of the contributions because again, it's on a pre-tax basis. The benefit to that is the tax deduction piece, right? So clients that are, in the upper, tax brackets, they're going to be looking at pre-tax 401k contributions to help alleviate some of the tax burden that they have on their income, right? So again, generally that's traditional 401ks / pre-tax 401ks. And then you get into the world of Roths where, if I kind of use that pay stub example and you look at your 20K contribution, if that's going into the Roth, well, that's done with after tax dollars. So you're paying taxes on that money when you make as you make the contribution. So taxes get taken out, then the contribution goes in, and that money now grows tax-free forever, right?
Okay. So then, all right, so now we know that, we have, Johnny over here where it's like we figured out how much we want to contribute. Now it's like, okay, do we want to write off that 20,000? Do we want to lower our income by 20,000, which means less taxes now, but now that 401k eventually, whatever that amount is in there is going to be fully taxed on the way out.
Correct.
Or do we pay taxes on that 20,000 now and obviously, suck it up because obviously, know that there's less money in our pockets right now. But however, long term, that now grows tax free, and we don't have to pay it on the way out. On that one.
And sorry, just to add, a huge thing, like a huge way we think about it too, is like, again, I keep emphasizing tax diversification because I talk to clients about this all the time. Where if you look at where the deficit is today, if we're not betting men, right? But if you were, and you said in 20 years, where's the tax code going to be, right? Do you think we're going to be paying higher taxes in 10, 15, 20 years, or lower taxes in 10, 15, 20 years? Probably say higher taxes, right?
Right. Oh, for sure.
So if that's the case, right, obviously you want to be mindful of what I said about pre-tax contributions being tax deductible, but knowing that you want to, generally speaking, tax diversify your contributions so that if taxes do go up several years down the road, you have some allocated in Roth, you have some pre-tax, and then obviously for the, the folks that are, making above what the contribution limits are, then you're going to after-tax dollars.
Well, you may have just answered my question because let's just say I got $20,000 to put in. Do I have to do all traditional or all Roth 401k, or how do I decide what to do, and then can I split it up?
It's a good question. Absolutely, you can split it up. Employers, if they do offer the Roth 401k option in addition to the pre-tax sleeve, they make it readily available for you to be able to split your contributions of 50-50. 75-25. Again, you have to look at, again, kind of where you're at, right? How close are you to retirement? Where's your existing tax allocation, right?
Almost like your outside accounts, you mean?
Bingo, correct. Okay. You got to look at everything, right? And then you also have to take a look and say, okay, well, where, and you also look at where your tax bracket is today. Where are me and my wife currently paying taxes? Are we in the 28? Are we in the 32% bracket? If you're in the 32% bracket and you're, let's say in that example, well diversified with Roths elsewhere, well then you would dial up your pre-tax contributions to continue to reduce your taxable income. Another good reason why you might do a pre-tax allocation is, let's say, you had a huge bonus this year that you weren't previously expecting. That's another way to help alleviate some of the tax burden. So you kind of look at it on a year in, year out basis. And to kind of just go back to your question, you can adjust it pretty easily.
Yeah, so it's pretty dynamic.
Very dynamic, yes.
Totally. But it just shows too, and I'll just kind of pause there for a little bit as a quick sidebar. I mean, it just shows that all these decisions, I mean, it's not just the, okay, do I want to do Roth 401k versus traditional 401k? I mean, you're looking at all of these outside factors, right? And so you truly need to take a look at your entire financial picture when selecting these 401ks. And I think it's just a great symbol or very symbolic of what we do here at SHP, which is take a look at that big picture. Take a look at your cash flow. Take a look at your outside accounts to see the taxes. Take a look at your budget. Take a look at your long-term goals, right? I mean, that's the type of value that a professional financial advisor will do.
Absolutely.
We're fiduciary CFPs that obviously that we are here at SHP. And I know it's a shameless plug for what we do, but at the same time, this is our podcast.
It is, right?
Yeah, so that's
the retirement roadmap?
Yeah, that's what I say. I did at the beginning, so I think it's okay to say this. But all joking aside, it's true. I mean, and it's exactly what people need, and I just love to provide that value because, as I said, even something like the 401k shows how complicated it can be.
Can be, yeah.
And you have each step to take, and you have each decision to make. And if you don't have someone to kind of to help you make those decisions, then you will make mistakes,
Totally.
or you'll certainly miss opportunities. Right?
And just to kind of put a bow on it, it's not a set it and forget it strategy, right? As much as easy as it is to automate your contributions, to automate your investments, to automate whether I'm doing pre-tax versus Roth. Well, your situation might be changing year in, year out, right? So, forget the investment piece for a second, but understanding how much you're contributing, whether I should be increasing my contributions, decreasing them. Should I be doing Roth? Should I be doing pre-tax, depending on where my income is, right?
Mm-hmm.
Those are huge things. And obviously the match is a huge piece of it too, because if for like I said, for whatever reason, if you leave an employer and you're 2 months shy of, your vesting schedule, you might be leaving thousands of dollars on the table and you don't even know it.
No, absolutely. And,
So,
no, it's a great point. But let me go back now to what you just said as well, because to kind of go through that timeline, right? So now I know how much I'm contributing.
yep,
Now I know what my vesting sort of schedule is, or the sort of like the details there. Now I know what the taxation is. What about investment options? Because you talked a little bit
yep.
about it just there. So now, how do I invest this money?
So it's funny the way I talk to clients about 401k plans all the time. It's interesting because the 401k world, it's a business, right? So I'll use Microsoft for example. If you work at Microsoft, Microsoft's probably going to pay for a Cadillac plan for their employers, right, or their employees, I should say. So their 401k plan is probably going to have some pretty solid investment options at a low cost. They'll probably give you a Roth 401k option. They'll potentially let you do something called backdoor Roths as well. There's the better the 401k plan is, the lower cost the funds are, the better potentially better investment options you do have available to you. But that's not for every company you work at, right? If you work maybe for a small mom and pop shop, their 401k plan might not be, like I said, the Cadillac plan that's giving you low cost investment options, that's giving you a Roth 401k, that's giving you, options. Maybe we'll get to the loan piece in a second where if,
Yeah, no, I definitely want to get to the loans
yes,
afterwards. I want to talk about sort of like
correct,
standard stuff, and then I do want to talk about the loans to help
correct,
us understand that.
totally.
Keep on going.
So, like I said, it comes back to the type of plan that you're in. So you need to understand what that looks like. And from an investment standpoint, that's the biggest thing that we're looking at. We're trying to look at, again, best in breed funds within your 401k that are at a relatively low cost, right? So again, it also depends on, where in the life cycle you are of your retirement journey. Are you 2 years out from retirement? Are you 20 years out from retirement? And one thing we try to tell clients all the time is if you're 2 to 3 years out from retirement, well, if the market pulls back, we'd be very reluctant to make any drastic changes if you're already, well allocated. And that's something that, I've seen clients make mistakes on where they're like, okay, my 401k is, call it 65-35 stocks to bonds. I'm 2 years out from retirement and the market's, down 10%. I'm going to go to all cash. Well, you're potentially, like, again, we talk about this all the time, time in the market versus timing the market. Mm. So from an investment standpoint, we always try to, as advisors, loop clients in, even though we might not be managing 401ks, but trying to co-manage that piece of it with them to handhold them through certain market volatility moments. And also try to make sure that they remain well allocated during those times.
Well, and I was going to say too, I think an easy hack is something they developed recently is what's called a target date fund or a TDF. In target date funds, what they'll do is they'll have target date fund 2060 or 2040 or 2045. And that's the year that individual, that employee is going to be turning 65. So it's meant to sort of be rebalanced. So like a 2045 target date fund right now might be a little bit aggressive because it's 20 years from now. But as 2045 the year nears, it becomes more and more bonds. It's
correct.
it gets sort of rebalanced towards a more conservative portfolio through time. Now that's again a very easy hack, easy win depending on the situation. However, if you do have sort of financial advisors in your corner, then you're not doing sort of like the easy way out, if you will. Then they're taking a look at the actual holdings that you have, and then we'll match them up to our portfolios. So SHP has, we have our core portfolios, moderate and things like that. Now we might not be able to have the exact funds that we would prefer. Correct. Because we're limited, by the 401k provider. However, we can match it pretty well.
Pretty close.
Exactly.
Yeah.
And that's just part of the benefit again of having a guy or a gal in your corner.
Absolutely. And just another thing to keep in mind too with 401ks, specifically with Fidelity, right? Because we work with a lot of folks that have Fidelity 401ks. This concept of like a brokerage link, right. Not a lot of clients might be familiar with it, but it's a way for you to basically open, again, I'll use the word sub account within your 401k And rather than investing in just the menu of, call it 15 to 20 options that the 401k plan provides, well, now the floodgates potentially can open, and you can hand select certain stocks, hand select certain bonds that are outside the scope potentially of what those 15 to 20 options are just in the 401k plan. So again, there's a lot of nuances to 401ks outside of just, logging on to Fidelity and seeing what's available to you. Loans, brokerage links, there's all these different things available. And it's just important that clients actually take the time when they do, sign on to a new employer or with their current employer to understand what that vehicle is and what it can provide them.
No, absolutely. Okay, so let's go full circle here, and then I'll eventually get back to the loans. So now we have figured out how much we want to put in. We've got the match from the company. We've got the taxation sorted out. We have the vesting schedule sorted out, and now we have the investments sorted out. Whether it's a target date fund, brokerage link, assistance from a financial advisor, so forth and so on. And now I've just turned 60 or 62 or 65. How do I get out of a 401k? What happens? How do I exit out of this? Whether it's an old 401k, let's say I left the company 10 years ago and I'm still working, or I'm 65 and now I want to retire. How do I get out of the 401k?
It's a good question. So every 401k plan, right, is held with a custodian, whether it's Fidelity or Schwab or Empower, whoever your employer used for their 401k plan. So unless that changes, which rarely it does, the first step you would take is to call your 401k plan provider and just get a little bit more information as, what's my current balance? What's my pre-tax allocation? What's my Roth allocation, right? You kind of just want to understand, if you haven't viewed the plan in a bit and you're trying to get out of it, kind of where are the basic figures? Where am I at? What's my pre-tax Roth allocation? And then from there, you kind of work with, whoever you get, at the 401k plan department to say, hey, I want to roll this out. Now, there's a few ways that can happen, right? You can potentially roll it out directly, direct deposit, if you will, into your IRA or your Roth, right? Depending on what you have in each bucket. Or, they might tell you, hey, we got to cut you a check, right? At which point you would just make sure that you try to get that deposited, within 60 days.
Okay.
Right? So there's a few things there where if it's a check, you want to make sure it gets deposited within a timely manner. But if it's direct deposit into your IRA or Roth, well, then it's a relatively straightforward process. Overarching, the reason why you do that, again, is for the flexibility of how you can invest the funds in your IRA or your Roth IRA. Because like we said, generally speaking, your 401k plan is like limited to 15 to 20 fund options. So the biggest advantage that we tell clients is, rather than, going to like a steakhouse where everything's kind of, or, let me rephrase. The best example is your IRA and your Roth is kind of like a steakhouse, right? Everything's kind of a la carte. You can kind of hand select the things that you want to invest in, you want to, I guess, eat, if you will.
Yeah, absolutely. No, keep it coming. I haven't had breakfast yet.
Yeah,
so this is great.
No, I think I'm hungry. I think I'm hungry is the biggest takeaway there. But again, generally speaking, the biggest reason why clients move it to an IRA and a Roth is for the flexibility of how they can invest the funds.
Okay. Yeah. Right.
Okay.
They have complete independence.
Yes,
there.
autonomy with how they invest.
And as a reminder for all of our listeners, so IRA is individual retirement account, and then obviously Roth IRA is that after tax or tax free individual retirement account. So your 401k funds, depending on the tax status, will get split between those two accounts. So you need to have IRAs or Roth IRA accounts open, ready to receive the funds.
Yep.
And not to get too wonky, but some of the 401ks even have after tax dollars in there, like brokerage account dollars. So it can get a little.
We could spend a separate day on that.
Yeah, absolutely. About how that works, and
you
you talked about backdoor Roth IRAs. So there's almost like maybe we'll have it come back and do like kind of like 401k
Some
part
breakdown,
2,
yeah.
right? Yeah, because there really is some extra nuances, like you were saying before.
Yeah.
And right now my goal is just the basics.
Yeah.
Just to make sure
Right.
everyone understands it. And then primarily people will do it when they retire, when they're 62 or 65. or 60 or whatever that is, or if they've left that employer and they're still in their 40s and 50s and have an old 401k.
Yep.
But you mentioned about the steakhouse and about how with IRAs and Roth IRAs, you have complete sort of autonomy to do whatever the heck you want to do, whether it's funds, individual stocks, individual bonds, CDs. You can do whatever the heck you want to do with it. And primarily, as I said, people will do it when they retire, when they've left that job. However, there is something called an in-service distribution. What is an in-service distribution?
So the best way to think about an in-service distribution is if you are of the age, let's say you're older than 59 and a half, okay? Specifically older than 59 and a half. You can do what's called an in-service distribution or rollover, where you can now roll over your outstanding balance, right, whatever your 401k balance is, into your respective traditional IRA or your Roth IRA, depending on how much you have in each bucket, right? So it's a way for clients, if they're still working into their 60s, to give them better flexibility by investing those dollars in their personal retirement accounts. Now, that's not to say you're going to get rid of your 401k. You're still going to make those contributions. You're still going to make those decisions based off of everything that we've talked about. How much I put in Roth, how much I put in pre-tax, what's my investment allocation, all these things. You're still going to do that in your 401k. Future contributions will still go into it, but the balance is something that you now can basically slide over into your IRA and your Roth to give you a better idea of how I can invest these funds with, again, we call them best in breed funds, right? We're kind of doing the due diligence at SHP to say, okay, does this international fund match up with our expectations? And we can kind of hand select certain funds on our end. And then again, clients can also do that. So that's the biggest reason.
Yeah. And I think I think my takeaway for all of our listeners is the fact that you don't necessarily have to be retired or severed employment in order to sort of take control of your 401k. It can happen while still working. Now, there are limitations, 59 and a half, and there's some fine prints, age-wise and different things, and sometimes even company-wise. But just something to explore and to consider, because in a perfect world, we generally would love to, obviously as early as possible, but especially if you're considering retirement, we want to be sitting with you 2 years, 3 years prior to retirement, just to get all of our ducks in a row. And as I said, we can still see people after they retire, don't get me wrong, but in a perfect world, we see people beforehand, and then we consider things like in-service distributions. We consider different ways of getting the more control and more of an alignment between your entire financial picture and what is, generally speaking, most people's biggest nest egg, in the 401k.
Correct.
So in-service distribution is something to consider. Besides, of course, again, if you're just retired or if you have severed employment, then we're talking rollovers, which all of these things are tax-free. By the way, generally speaking, we'll get questions like, "Oh, is there taxable?" Like, no, it's going to go from custodian to custodian.
Yep.
It's going to go from your 401k provider to your IRA custodian. It never goes into your pocket. As long as it doesn't go into your pocket, it's not a taxable event.
Yes, and just to go back to the whole pre-tax Roth piece, it's very important that you understand when you jump on, a rollover call with the custodian to understand what amount is in your pre-tax versus Roth. Because you don't want to commingle those assets, right? And then have, let's say, Roth money go into the pre-tax portion that you deposit into your traditional IRA. You want to siphon out, the difference and make sure you're routing, the correct dollars into the correct bucket to avoid any confusion.
Yeah, no,
tax
absolutely.
dollars.
Yeah, or getting a massive tax hit that you was unintentional.
Correct.
At that point.
Correct.
So okay, so we've now covered from sort of the beginning to the end of the lifespan of a 401k. All right. Do you want to give us some information on 401k loans?
Yeah, that's the fun stuff.
Well, yeah, because think of it this way, folks. So it's like where I went from a normal situation, right? You start work, you start making contributions, you get in your match, you're making sure you're vested, you're looking at your the taxation, the tax diversification. You're managing your investments either yourself or with a financial advisor. And now either as you retire or as you approach retirement, you're either doing a rollover in-service distribution. But what happens in the middle of that if there's an emergency? But what happens in the middle of that and you need to access your 401k? Can you? And so, Ref, can you?
Yeah. So again, it depends. Doesn't it always depend in finance?
Absolutely. Yeah.
It always depends.
That's our world.
We always say it depends.
Love that.
But
word.
again, going back to the whole concept of what does your 401k plan offer? Some 401k plans do offer, a provision where you can take a loan amount out. And usually they limit it, I believe, up to like 50 to 70% of what the outstanding balance is on your 401k plan. But again, potentially, yes. And the mechanics of that is important to note if you do elect it, because again, we've run into this with clients before, where if let's say you do a rollover or you do an in-service rollover out of the 401k plan, but you do have a loan on it, outstanding loan balance, you need to make sure one of two things happen. One, that it gets paid off, right, before you do a rollover. Or two, if you do a rollover out of it and there's still that outstanding balance, that you're continuing to make the minimum monthly payments on that 401k loan. Because what happens if you don't do one of those two things, the loan will default and become a taxable event for the outstanding balance.
That's no good.
So that's no fun. Nobody wants that. So it's always important to note and double check, because let's say you've been at an employer for 30 years. Maybe, you took a 401k loan for a small portion of it 20 years ago, and you were making minimum monthly payments for a long time, and you didn't know that balance still existed potentially. It's important to note, one, if you do a rollover out of the plan, like I said, you've got to make sure that either the balance gets paid off when you do the rollover, or two, you've automated the monthly payments to continue after you do the rollover to make sure that the balance is not default.
Okay.
So those are the two key pieces to make sure that you're not triggering a taxable event unintentionally by having that outstanding balance.
Well, I think I'll kind of leave it as a cliffhanger, because I wouldn't mind kind of having some time to, that's a cliffhanger, Jamie. Yeah, absolutely. There's 401k loans, and then there's Agatha Christie, and I'm going to go 401k loans on this one. But all joking aside, it's like, understanding 401k loans, because I have so many questions about, okay, it comes out of your pay stub. Is it better to... Why is a 401k loan better than a sort of doing a home equity if you have that option?
Yeah.
We briefly talked about backdoor Roth IRAs or backdoor Roth contributions, which also can be used with the 401k. And then there's companies like called Pontera and different things that allow all these options. So I think it's almost like I'd love to have you back, basically.
Yeah,
you gotta have like more of a complex dive into the 401ks. Because again, the loans, the post-tax contributions, all the limits on the different ages and things along those lines. But I think this was a good day to, again, from beginning to end, with the potential, loans in the middle, because there's also hardship withdrawals too.
Correct.
And if you're disabled or for a first-time homeowner,
didn't really get into that.
Yeah, exactly. There's so much more that we could really get into when it comes to the next level of 401k planning and then really 401k understanding. But I think we did a good job of just making sure people are not making the mistakes, i.e. taxable events, right? Whether it's through, not curing the loan or whether it's doing a rollover inappropriately.
The match piece too, making sure you're not leaving money on the table.
Right, exactly. Or just, walking away from some of that free money through the vestings. And hopefully we did a good job too of clearing up some of the misunderstandings that are there and how 401ks work, because as you said at the beginning, Raph, this is the replacement for the pensions. All of our grandparents and grandparents, parents had pensions, and they all stayed at one company, generally speaking, for their entire life. And so now it's a completely, you don't need me to tell you this, it's a completely different world. And if 401ks is sort of the bedrock of your foundation, is the bedrock of your retirement, you better understand them, and you better make sure that you're not making the mistakes and missing out on opportunities. So I hope all of our listeners found this helpful and put up with all my, silly jokes.
Yeah.
And was it all right, Raph?
Not too bad.
Yeah. Will you come back on?
Of course, man. Come on. Yeah.
This
Team
is
Matt.
awesome.
Team Matt.
Yeah, which ironically, I wouldn't even tell you like our internal team name.
Yeah,
It's a different, it's for a different.
We'll save it for the next podcast.
Yeah, again, cliffhangers,
right?
ladies and gentlemen. So
that's it.
Thank you all for listening so much, lending us to your ears, and I hope everyone has a wonderful day. Thanks for listening to the Retirement Roadmap podcast by SHP Financial. If you've enjoyed today's episode, be sure to hit the subscribe button so future episodes are automatically downloaded directly to your device. And if you've liked what you heard, please share the show. Create your own little ripples so we can help even more people with their retirement goals. If you want access to all past interviews, including notes, resources, and exclusive content from SHP Financial, visit shpfinancial.com/podcast. Thanks again for joining us on the Retirement Roadmap Podcast. And for all the attorneys out there, and disclaimers and disclosures, I'm just going to put on my super serious voice and add our own. No statements made during the Retirement Roadmap Podcast shall constitute tax, legal, or accounting advice. You should consult your own legal or tax professional on any such matters. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk, and unless otherwise stated, are not guaranteed. Our investment advisory services are offered through SHP Wealth Management, LLC, an SEC-registered investment advisor. Insurance sales are offered through SHP Financial, LLC. Our advisors and insurance reps may offer clients advice and/or products from each entity. No client is under any obligation to purchase any insurance product.